Hello everyone, and welcome to myfinanceteacher.org. We're going to talk about the stock market today, and we're going to mention the interesting event of yesterday, which is the FOMC meeting. Well, actually, it was not that interesting. Nothing special, really. Actually, FOMC meeting didn't give us any surprises, any unexpected news. My main theme for today, for this talk about the stock market, is that we should exercise caution in the stock market. Those of you who are not in the stock market at the moment, I don't really suggest getting into long positions now, which is relatively late within this current ongoing intermediate cycle. And for those of you who do have a long position in the stock market, I would suggest keeping the stops relatively close to the current levels. Earlier this week, S&P 500 had a slight peak above that previous high. At the moment, it's slightly below that high after the FOMC meeting yesterday gave us a red candle on S&P 500. But I think there is a good chance that over the next several days, S&P 500 is going to retest that line and possibly break above that. I do expect some sort of continued upward momentum in the stock market for a short while, although entering some positions now is relatively risky. So let's talk about the reasons why I think it is risky. First of all, let's have a look at the 14-day RSI. It has already been slightly into overbought territory. It doesn't mean that we're going to fall down from here. RSI can go further into overbought territory, and it might actually stay lodged there for quite a while. But it's one of the indicators that we might be nearing the top of this intermediate cycle, which has been going on since late December, by the way. So that gives us, over 4 months already. Based on historical duration of these intermediate cycles, we should expect a cycle which would last on average for about 6 months. For example, if we look at all through 2016, 17, and 18, within these 3 years we had 6 intermediate cycles. They, of course, vary in duration, but on average that gives us half a year per cycle. The current one has been going on for 4 months already. So what it means is that there is some slight potential for continued upward momentum for another few weeks, but I don't think that momentum is going to be strong, and there is a chance of just some volatility around the all-time highs, followed by a decline into intermediate cycle, well, probably over the next 2 or 3 months. So if you want to play with that risk, you might probably want to keep your stops relatively tight. Another thing that I want to have a look at is we are somewhat stretched above the 50-day moving average. Again, we're not that stretched above that 50-day moving average. We might still pull up further away from 50-day moving average, but we will eventually, I think, return to the 50-day moving average and possibly even break below that. Why do I think so? Again, looking at this longer term view, at least since 2016, every intermediate cycle has either pulled back down to this 50-day moving average, blue line here is also the 50-day moving average, or broke below that 50-day moving average and sometimes considerably lower than that 50-day moving average. We are currently only around 3.5% higher than that moving average. So it also gives us the same story. Basically, we might continue moving upwards, but there isn't much potential for considerable gains, in my opinion. Talking about gains, let's have a look at what we've had, well, let's say so far in 2019. Let's not even look at this low we saw around Christmas time. Only within 2019, S&P 500 has already gained nearly 21%, or 20.7%. And I think it's plenty even for a whole year, never mind only 4 months of the year. So what it means is if we stretch the same momentum for a whole year, if we annualize basically this return, multiply that by 3 for a whole year, that's going to give us 63% or nearly that much. And again, if we look at historical values for S&P 500 all the way since 1998 and even including the dot-com bubble, I cannot really see any year when we made over 60% in S&P 500. The highest I see here is this 53% gain that was in 2009 after the global financial crisis. This bounce up from the low gave us 53%. So what I'm trying to say is we already have plenty of gains for this year. And again, this just indicates that some sort of a cool down, some sort of a correction is due. It's not going to happen tomorrow. I think the prices are going to retest those all-time highs again. But as I mentioned, sometime over the next couple of months, 2 or 3 months, we're probably going to see S&P 500 pull back down towards its 50-day moving average. So personally, I did play this bounce up from the lows using QQQ, but by now I'm completely out of that trade. I will be looking forward to enter a similar trade when I see an intermediate cycle low and when I see a potential for the next bounce. Let's keep an eye open for that potential together. So stay tuned. Subscribe to the channel if you haven't. Give this video a like. I would really appreciate that. Make sure to hit that like button, especially if this video provided some value to you. In return, you can also provide some value to me by commenting under the video. I do appreciate all of your comments and I try to learn from them as well. That is all for now and good luck in your trades.